This is our Forex blog for March 28th, 2012. And like we do most days, we want to buy the strongest currencies versus the weakest and sell the weakest versus the strong. You can clearly see today the euro and the Swiss were extremely strong on both time frames. The pound was extremely weak throughout the day. Its weekly and monthly trend are up. However, its daily trend shifted down. The CAD pretty much down most of the day except for this couple hours of strength right here, but the daily and weekly trends down. And of course the Australian is the weakest of all the currencies. So basically what do you want to do? You want to buy the euro and the Swiss versus the Australian. You want to buy the euro versus the pound. You want to buy, or I'm sorry, you want to sell the weak pound Swiss. So let's bring up a chart. These are some of the currencies I don't typically leave running. Euro Australian. And you can see basically a nice smooth uptrend all day. And here's some of the patterns you would have taken. If you missed that first breakout right here, you might have bought that little pullback. I like to buy anticipated breakouts before they break the high, because a lot of times you can get into trades 5 to 10 pips earlier, and you can also have a tighter stop. By risking this amount versus if you bought the breakout of the high, which would have been somewhere around here. I mean, it was actually taken right here, but I'm trying to illustrate the amount of risk you had in the trade. You can virtually, cut your risk in the trade by, maybe 40%. So that means you can trade more lots, and if the trade works, like in this case it did, you make another 5 to 6 pips, but with a bigger position size, which could be a significant improvement in your trading results. It's all about small losses, big wins, and by trading more lots and having more pips profit, you make more money. And I can get rid of 1 or 2 losses, just those extra pips right there with bigger size can get rid of 1 or 2 losses that you might have later in the day, and you basically counteract those failed trades. Now once you're in a trade, usually drawing the fibs is the best idea for knowing where your profit target is. Most of the time the market stalls at the first fib, and virtually all the time, 75–80% of the time, the 1.618 is where it's going to go. It might pull back like this, go up a little bit higher, and come back. It's going to have trouble going higher without at least going sideways for about an hour to 3 hours, or getting a deeper pullback first. So that's the Euro Australian there. We also know that the Swiss was strong, so the Australian's on top, so you're looking to sell the Australian Swiss, and you can see nice smooth trend all day long. Really at 2 o'clock it was when the Australian got very weak, but it wasn't until 3 that the Swiss really started picking up. So you wouldn't really even be looking at this currency until about right here, and you might have got into the selling the low right here. And typically if you don't want to get stopped out, you put your stop a few pips above the swing high, and once it kind of goes your way and comes against you, I always move my stop down here. Did the same thing again, move your stop down. At this point you're in break-even territory, and you don't know how far it'll go, but typically when you have strong trends, they'll move 2 waves. So this isn't really much of a wave, but you draw your fibs on there, and the first fib target I tend to get out of half, and then I get out of the second half here, or I let my trailing stop get me out. You can also draw a trend line pretty much over these highs, and you would have been out of the whole thing right here, or you can use, if you have the chart running, our intelligent trailing stop. The FX build your own stop is the best stop we have in the software. We typically run this on range charts, but it only works in real time. FX build a trend stop. This allows you to use our best statistical tools in any weights, any settings, any time frames you want, and you can have different rules that tighten the stop under certain statistical situations. Like if the market moves statistically too far, we tighten the stop, because it's very likely to reverse, and therefore why give back pips of profit? So that's the Australian Swiss there. You can see also the pound was weak. I don't typically trade the euro pound too often, but on days like this you want to. And again, you saw at 3 o'clock right here, very strong euro. Now what if on a 5-minute chart you can sometimes find it hard to get into these trades? One of the best ways of getting into trades is using range charts. So let's just say 5 pips per bar, 5R, hit enter. It's going to go download tick data, and it's going to populate this. It's always best when you're using range charts to set the number of days to data to, maybe 2 instead of 6, because it has to download an absolute ton of data to populate the chart. If you're setting this up from scratch, you're better off changing the number of days of data to 2 first, and then, requesting the data. So you can see on a 5 pips per bar chart right here, and since the data is in, we can change it around. If you want to go to 6 pips per bar, you hit 6R. But nonetheless, you can see patterns on range charts that are just really clear. Nice little flag pattern, flat top wedge pattern here. Oops, let me draw the trend line off the lows here. And you can see this beautiful breakout. And on a range chart, if you miss the initial entry, rather than a 5-minute chart, which might move 15 pips on one bar, this is only 6 pips. So you could conceivably buy the breakout if it goes 1 pip above the previous bar's high and put your stop 1 pip underneath the bar's low and literally risk 6 pips plus 1 or 2 plus padding. So you're always risking 10 pips or less. And so if you get into a trade like this where it has a good chance of going 20, 30, 40 pips while risking only 10, that makes sense. Some of these trades just take off and never come back. So if you have up some range bar charts, you can get into them. And also notice how beautiful this pattern is. You have a nice little down move here that went up. It failed here at the highs. You have the exact opposite pattern here where it didn't break out to the upside. It broke out, had a flat top, and it broke out through the uptrending trend line. And then you have the exact opposite pattern here where it broke out to the upside. You can also take these trades where once you have a strong trend, I like to have a deeper pullback, at least 15 pips. So I might avoid, usually I will say, probably 90% of the time, I will avoid a small pullback like this, but I will take a deeper pullback like this. And you can simply put your stop underneath the bar's low, and every time it goes up, you move your stop up. And so you're very quickly into a profitable situation. You always got to be aware of where the previous swings are. If it can't break this high here and it goes sideways for a few bars, I'm typically going to get out of the first half of my trade and put my stop, a pip underneath those lows. So I would have probably been in this trade here at 79. You're never going to get every pip, so maybe out at 92, and then out of the second half at 87 or 86. But this first breakout, you can see it went from 63 all the way up to 95. Nice, decent trade where you have a win that's significantly bigger than what your risk is. And that's the key to trading right there.